Okay, well, welcome everyone. Today is June 23rd, 2015, and this is SMB's Options Tribe meeting. For those of you who are here for the first time, the purpose of an Options Tribe meeting is to bring top-flight options experts from all over the world to meet with us every week and talk to us about options strategies, trading psychology, options theory, new strategy ideas, new adjustment ideas, etc. And we also run at SMB an options trading desk, and basically members of our community who've trained with us end up, in certain cases, if they're excellent, trading our capital at SMB. We could talk about that a little bit later. But we hope that you walk away from every Options Tribe meeting with some information that helps you to improve your game as an options trader. I'd like to point out that SMB Trading is not a broker-dealer. We're doing these webinars for educational purposes only. Today's session involves no relevant or live positions, and any hypothetical computer-simulated performance results or pricing or P&L that you'll see on the screen today are just that. They're hypothetical, and they are not subject, and they therefore don't take into consideration liquidity, slippage, and commissions. Options trading is risky, and you should not expose any of your capital to options trading until you understand the risks and accept those risks. A good way to do that is by going to your online broker and asking for a document which explains the risks of option trading. And even then, if you accept those risks, you should trade very small, and always trade a percentage of your net worth that will not change your lifestyle if you lose it, because there's always a potential for a substantial loss in options trading. So with that, I would like to welcome back to the Options Tribe for the umpty-umpth time, John Locke. Really, this is where it all began with the Bearish Butterfly, the first series that SMB did in our SMB Options Strategy series was the Bearish Butterfly, and John was the author and presenter of that. And so welcome back to the Options Tribe, John.
Thank you, and welcome everybody here. Did you want me to share my screen now, Seth, or do you have other stuff you want to go over?
Yes, and the title of today's session is The Bearish Butterfly Play to Win, and you'll want to stick around obviously for John's presentation, and you'll also want to stick around for the special offer that we're going to be making in connection with the Bearish Butterfly at the end of today's session. So, John, I am going to give you the screen now. And
okay, fantastic. Let me see if I can get my correct monitor shared. And you should see our famous SMB disclaimer, which you've already heard.
John, we're not seeing any. There you go. Now we are seeing it. Yes.
All right, fantastic. Well, we have the same stuff here, so we shall move on.
Yep.
And just like to say to welcome everybody. Thanks for joining me. For those of you who don't know who I am, obviously Seth told you I was John Locke, but I'm founder of a company called Locking Your Success, LLC. If you'd like to visit my website, it's lockingyoursuccess.com. Down here, LOCKE with the E. And I am a performance coach and mentor. So that's mainly what we do at Locking Your Success. I'm also a retail trader. I trade both myself and I trade professionally on SMB's options desk. So with some of the strategies that we sell and package together. So, and that's the other thing we do is I've developed programs together with SMB that a lot of professional traders use, as well as retail traders. So very, very effective.
I want to go even farther than that to say the vast majority of the trades going on our SMB options trading desk are the trades that John developed. And not to get into results, but let's just say that SMB is very satisfied with the outcome so far and is anxious for us to grow our options trading desk. And in fact, some of you here today probably will be getting a call from us shortly to talk about joining our desk based on your terrific performance in the options trading contest. Sorry to steal your thunder, but I just wanted everyone to be clear that what we're talking about here today, we're trading live on the trading desk. John trades it live. We all trade these same strategies live, so they do work.
Yes, we do, and we haven't got kicked off the desk yet, so we must be doing something right.
That's right.
All right, awesome. So anyway, I'm really excited to be talking about the bearish butterfly. This is my favorite rule-based trading system. It's my first and my favorite. And, I don't know if it's because of the money or maybe it's because I've been trading it for so long, but, I kind of think about the bearish butterfly like it's remembering a long-time friend who's been by your side through thick and thin. And, I remember when I came up with this strategy about 9 years ago, I'd been through many of the major trading programs where I learned all about options and the Greeks and these income trades like condors and calendars, and it was really a lot of great information. At least in theory it was, because when I tried these trades, yeah, sure, they'd work sometimes in certain environments for a period of time. I'd get a little here, I'd make a little money there, and unfortunately, though, when the losses came, as they inevitably do with any strategy, you're going to have some gains and losses. But when they came, they were very big compared to what I was actually making. As a result, I'd lose all my gains, and often even a lot more than I had made, and ended up being behind, taking what would ultimately probably take years to get back. So my basic thing is thinking, wow, this simply doesn't work. All these things that I've spent all this money on trying to learn and everything, it's just not working. And, it might work for a little while, but it's certainly not working long term. So how am I going to take $10,000, which is essentially all I could scrape up about 9 years ago, and turn it into something where I can actually support myself trading options? I mean, even if it did work, these strategies that they were showing me, even if they did work, I'd be making more money trading with $10,000. I'd be making more money working at McDonald's than I would trading options. So I'm trying to figure out, how's this going to work for me? And I'm saying, well, there's got to be a better way. So what I did is I went to work designing a high probability, high yield trade that takes advantage of natural market movement, yet doesn't rely on it. Something that's capable of very high returns and wins most of the time. But when it loses, or if it takes a loss, it's going to be representative of what the wins are. So what I wanted to do is I wanted to play to win. So I came up with this butterfly that I positioned behind the market. I entered, in other words, a butterfly position that I entered partially, bearishly positioned behind the market, that I would enter when the market's been up a little bit, and if the market went against me, I'd scale into this trade deeper and deeper until I get to the point where the market pulls back. I take out a large amount of money, and then I'm able to take my win and move on. So I put that together. I played with it over and over again, and I ended up making these really great returns in the market. And since then, I've traded this thing through some of the most challenging market environments in history. We had the 2008 market crash. I traded through that. I traded through the largest bull market in history. We've had the flash crash. We've had the 2011 crash. And through it all, I've been trading the bearish butterfly, and I've done really well. I mean, there's been times when we've lost. There's been periods like 2013 where we had a straight-up market, and we had a rough time due to the extreme bullish conditions. But the returns averaged over the last 9 years are just, they're simply incredible. So what I'd like to do is kind of show you how this thing works. So what I was thinking at the time is the market runs in cycles. It runs up. Even a bullish market runs up. It runs back for a little while. It runs up. It runs back for a little while. And I'm thinking, as long as I don't catch the very bottom of some of these larger moves, this trade is very, very likely to win. And a lot of the times, if I time it right, I can take in some really huge wins. So I went ahead and I started doing that. Ultimately, if this trade, best case scenario, is if I can call the market talk within 40 points, that's a pretty big margin of error there, right? I can do very, very well. And realistically, a lot of times I can be miss it by 60 to 100 points sometimes and even still do okay. So very, very durable trade. So the bearish butterfly was designed to be traded on the Russell 2000. It can be used as a monthly income trade where you just pick a day, you ignore charting, you enter it, and trade it out. It can be used as an opportunistic income trade for those people who like to time the market a little bit, which is essentially what I like to do at the time, and I still like to do that. I time the market a little bit and trade this a little bit more opportunistically, so it could be traded either way there. It's a fantastic alternative to a bearish vertical. One of the challenges we have with the market's overextended and you put a bearish vertical on is generally the volatility is pretty low. You're not getting anything for credit for your vertical spread. Therefore, a small market move against you is going to take you out of the trade. In other words, you have to be very accurate. And even if you do win, the returns are kind of lousy because you're not getting any credit. So rather than do that, you can do a bearish butterfly. You can be wrong by 30, 40, 50, 60 points. And as long as you're correct eventually, oftentimes pull 10, 20, 30% out of the market, sometimes more. So a great alternative for that. I've also used it, or my students have used it, as hedges on bullish positions. Like, for example, if you have a long portfolio, especially if it's heavy in small caps, but you can do this on the SPX too if you have S&P 500 long stock, the related stock, then you can put a bearish butterfly on, especially when the market's a little overextended, and you can hedge off the losses on the pullbacks or even make up sometimes a lot of money if the market's relatively flat. So it's great for that, and it's also a good alternative to a covered call because you're capable of making a lot more money and losing less in a down market situation. So those are the types of things where we use a trade like this. For today, what I was going to talk about is using it as a monthly income trade. That's how it's focused on within the program, although there is a bonus market timing section that is included in the program. But it's generally demonstrated as a monthly income trade, ignoring technical analysis. 56 days to entry. It has a fairly high profit target of 30% planned capital. Within the program, we also have a low profit target. What we like to do is we like to get people out of the trade as soon as possible if it gets near expiration, because unless you get experienced trading it, you generally, I'd rather not see people managing it there. The gamma gets kind of high. So we reduce the profit target for that. We have a maximum acceptable loss of 30% of planned capital, and this can be traded with as little as $5,000. Although in the program we're doing it with 50. It's a little more challenging to trade with 5,000, but again, there's a section in there, a bonus section that shows you how to do it if you happen to pull into expiration. So that is essentially the way the program is done. If you follow the program, and thus far in 2015, just to get an idea of how things generally work, this is what we usually figure, right? For each month trade, we have a profit target of 30%. We have a max loss of 30%. It's pretty rare that we actually hit the 30% profit target. It's also rare that we hit the 30% maximum loss. Usually it's somewhere in between. So if you have something like 2015, January actually took a loss of 13.3%. The good thing about this trade is usually when it takes a loss, usually it comes back right away. So money's right back the following month, followed by another 14% gain, followed by another 14% gain, followed by about 12%, and then 20% in June. So for a 6-month period, we had 5 wins, 1 loss, and we're at about 64.4% for the year. That is typically a little bit better than average if you're using it as a straight income trade. It's less than average if you're using some market timing with it. So in general, that's the type it is. It's a very high yield trade. We're not talking 2% a month here like we are with a lot of other trades with the probability that might have. So what I'm going to do is I actually have 3 examples ready to go over. I don't know if we'll get through all 3 of them. They're actually fairly short. 2 of them are fairly short. The third one's a little longer, just to give you an idea of how things work. So this is a 2014 expiration, entered on 2/21/14, which is going to be 56 days to expiration because we're not taking charting into consideration. We have a $50,000 planned capital, so it's a larger size trade, which would give you a high profit target of $15,000, a 21-day to expiration profit target of $5,000, and a maximum expected loss of $15,000. So if we were to enter, let me see this. So in general, how it works, we're going to scale into the position. We start with 1/3 of the position size, and we enter 50-point wing butterflies 20 to 30 points below the price. It doesn't matter if they're call butterflies or they're put butterflies or they're iron butterflies. They're all synthetically the same thing. They all fill, regardless of what anybody tells you. They will all work. Everything's fine. I prefer to use put butterflies. From a secondary standpoint, I would use iron butterflies, and I probably would avoid call butterflies only because most of the time you're going to be deep in the money with everything, and you're going to get some wacky pricing for mid-pricing. But generally, that's what I would prefer to do. So it starts off with 1/3 of position, 20 to 30 points below whatever the price is in the market at the time. If you get an up move that gets a total of 40 points over your short strikes, we're going to add the second third of the position. If you get an up move 60 points over the short strikes, you will add the last third, and then we have a roll sequence that starts at 70 points over the short strikes. Again, the underlying is the Russell 2000 on the trade. There are also delta and theta triggers that go along with this that are within the program, but let's just stay with a basic framework for now. So this entry would be February 21st, 2014. Russell's at 1167. We have 50-point wing put butterflies, which is what I prefer to use as far as put or call options. I prefer to use the put butterflies. We are about 27 points behind the market. This is a positive theta income trade, and it's going to be negative delta pretty much unless the market forces you into a positive delta situation.
John?
So that is, yes.
We have a couple questions that have come in. You want to be
sure.
Now? Okay.
Interrupt me as you will.
All right. One question is, you sometimes say based on the price of the bearish butterfly, they're pricing it to the downside or pricing the upside. Could you please explain that? Are you looking at the skew or what?
Can you say that again?
Well, you sometimes say, based on the price of the bearish butterfly, that it's being priced with an anticipated move to the downside, or it's being priced with an anticipated move to the upside. So could you please explain that? And are you looking?
You can essentially, right? This is something that's a little bit more advanced by somebody who's probably watched my market updates or whatever. So so I'm looking at this and I'm looking at what's my delta going in as compared to what it normally is, and what's my delta theta ratio. Typically, if they're expecting a larger market move, particularly to the downside, you're going to have when you enter the butterfly, you're going to be less delta, and the butterfly is going to be cheaper. This here has this entry. We have a $10 butterfly, 56 days to expiration. That's pretty much normal. If we were at $7, it would be indicating that they're expecting some really high volatility going on. If you were up at a 13 level, it's generally going to be a low volatility grinding up situation at this many days to expiration. This delta is a little bit high, indicating that they're pricing the options chain like the market's probably going to rise. In other words, they're thinking it's going to rise. If we're looking at the 80 minus 80 level, they're pricing things like the market's likely to come down. If I get much higher than, say 150 or up to like 180 or 200, then that's going to be a very low volatility market environment where there's really no fear to the downside. So I guess that's probably what you're asking. And that stuff comes into play with the rock trade too.
And the second part of that question is, how do you decide on 20 or 30 points below the price?
Oh, okay. Yeah, well, that's a good one. I mean, essentially, if I had to go 19 or 21, I go 21. If I have to go 30 or 31 or 21, I'd go 21. So I want to be between 20 and 30. If I'm smack dab at 30, in other words, if the market was right on 1170 and I had to decide between an 1150 and 1140, I might take a little bit of, if I had a market bias, I might take that into account. Right. If it could go either way. But generally it's just going to be between 20 and 30.
Okay. Thank you.
Yep. All right. Is that it?
Those are the questions.
Okay. Yeah, so this is a fairly normal entry here. It's around $10. Delta's a little bit high. So, for those of you who have listened to me before. So anyway, this is what the starting position looks like. I am starting with the 1140 butterflies. It gives me an add point of 1180. It gives me an add point of 1200. And if the market continued to go higher after that, we have what we call a roll point at 1210 and 1220. So from here, if we go all the way to March 3rd, right, and that was quite a bit because we went from February 21 to March 3rd, so quite a few days here. We have exceeded our roll point of 1170. We actually did that a couple days, the day before, or actually the Friday before. But this was a situation in OptionView where they had no data that day, so we just skipped ahead to March 3rd. The really great thing about this trade is it's kind of like you check it once a day. If you go past your adjustment point, it actually doesn't matter. A lot of times you're better off. So it's not a big deal that we're all the way up to 1178 if we had an add point a little bit lower. But actually 1180 was our add point here. So actually we're not to our add point. So, but you can see it dropped down from the day before. The reason I didn't, I'm showing it to you here is because at 1530, I just looked at my notes. At 1530, this was actually over 1180. So if we're over 1180, then you can add it. You don't necessarily have to. And in fact, in this case, when we go to the next day, I would have been better off had I not added this second third. It went way past my add point. But this is the worst case scenario. So we come in here, we add the 1160s, and that actually increases our delta a little bit and puts us in a good position if we have a reasonable pullback that we do very well. This is as far as I like to get in the trade. In other words, I love the trade when we get 2/3 scaled in, and then it pulls back into a range for a little while. Those are usually your best months, your easiest months that are easy to manage. In this case here, we ended up the very next day going up 30-plus points. Right? I think it was like 37 by the end of the day. So in this case, I would have been better off had I not added that second third because I would have lost less money. So by ignoring the adjustment point, if I happened to miss it that day, I would have actually been better off than if I didn't miss it. But I did add it, and that we had a large move, which drew us down about $8,000 here. And this is a situation again where I'm not quite past the roll point. I hit the second add point at 1200. I have a 1210 first roll point. I'm not quite there, but by 1530 I was past that point. So I'm just demonstrating what we would do here. We would pull off the lower butterflies. We would roll them up 60 points, and we would add our last third, and that would essentially put us into a position that looks like this. We have 3 butterflies at 1160, 1180, and 1200, and now we're fully scaled in.
John, we've got a question here.
Yep.
Can it be a problem if the market grinds higher without much of a pullback, such as we had most of 2014 and so far in 2015?
We had no trouble in 2014. It was a very good year for the bearish butterfly. We've had 1 month this year that gave us a problem with January expiration. The rest of the year has been fine. So what will give you a problem? A market like this generally isn't a problem. This month may be a problem. The July trade is down, but it's not down but not out, as they say. We'll see what the market does. If it continues to grind, it's a possibility we may end up losing July. Generally, a slow grind doesn't bother you too much. What bothers, because of the delta theta rules, what bothers you is, what's going to bother you, though, is going to be just a very low volatility, rapid up move like we had in 2013. 2013 was the worst year I've seen. The bearish butterfly traders who timed the market did excellent in 2013 because they watched the market cycles a little bit. The bearish butterfly traders who traded 2013 completely ignoring the charts, we kind of had a situation where we had a very strong up move, and a lot of the entry months were actually the very bottom of the market. So the lowest price point was entry day, and that will give you a challenge. If you hit the bottom of a large trend and it does not pull back, that could stop you out. So,
John, Elad is asking, what would be the minimum suggested starting capital for this trade?
Well, like I was saying, you can trade with as little as $5,000. So if you're up for a $5,000 trade and you can take a $1,500 maximum loss with your account size or your net worth, then that would be appropriate for this. If you get into expiration guidelines within the program, you have to. I have a special section that shows you how to manage that because it's a little bit harder to adjust if you pull into expiration. But if you choose to use the expiration guideline,
all right,
Peter's $5,000. Go ahead.
Peter's asking for you to show the last adjustment slide again. I think it's the previous slide, John.
Yeah, I can actually toss that in option view too and go back to it. But here, all we did is we had butterflies. We had butterflies at 1140 and 1160. So we took the 1140s, we moved them to 1180, and we added 1200s. So it's a matter of removing. I know this looks complicated, but all we're doing is we're removing one butterfly, and we're adding, or one set of butterflies and adding a set at 1180 and adding a set at 1200.
Okay. We got tons of questions coming in, so
that's okay. We can either go through. I mean, and I'm happy to do either. We can either go through other examples or we can answer questions. So it's all great. It's all good as far as I'm concerned.
Yeah, I think we should go with the questions. Let's try to get if they're popping up in a lot of people's minds. Okay. Wow, so many good questions. I don't even know where to start. All right, I'll start with the first one. With implied volatility historically low for the rut, wouldn't put credit diagonals be a similar but preferred structure, a positive Vega trade?
Okay, yeah, so legitimate question. Put credit diagonals. You can use those. That's one of the things that you can do. It does react similar. Typically, you don't get as much bang for your buck, as they say, doing a credit diagonals than a bearish butterfly. So your returns are going to tend to be lower. Right. As far as the volatility aspect of the thing, when you're looking at a diagonal, you're not looking at. You can't use your volatility number to determine whether or not the value of your position is going to go up or down when volatility increases, because what you're looking at is a composite volatility of a back month versus a front month, and your modeling in your software does not take into account that usually when you get a large volatility spike, your front month, or the one your negative Vega, comes up a lot faster than your back month.
Right.
So with a hard down move, you still experience the same drawdown, whether you're positive or negative Vega, most of the time. sometimes it's worse. So just the fact that it says you're positive vega does not protect you from a volatility issue. The reality is, whether you're in a calendar, a diagonal, or a vertical, you're going to get hit hard by the initial volatility spike if that happens to happen in the market. So the difference being, if the volatility stays up and starts to affect the back month, the other trade will eventually come back, but most of the time you're stopped out by then anyway. So yeah, I have no concern about being negative vega. Hopefully that made sense.
Yes. Andy's asking, John, how many points to the upside can the bearish butterfly handle well without going into a loss?
Without going into a loss, or without losing?
Well,
essentially you're negative delta, so you're going to go negative profit loss if you enter and you get a substantial up move.
I think he meant actually losing the trade.
Right. So what's going to happen is it's going to be very dependent on what your entry price is and timing. If you get an entry price of, say, $8 or $9, indicating, in other words, you have a relatively flat delta entry, and you get a fast, hard move in the market to the upside, I've withstood as much as 120 points. On the other hand, if you are in a situation where the volatility is very low and you're entering with a $14 butterfly or a $13 butterfly, about 50 to 60 points, you're about done. So it's volatility. It's really dependent on how they're pricing the options chain at that particular time. And of course, the later you get into the trade, the less price movement to the upside it takes. Which is why I really love to enter these 56 days to expiration. If the market sits for an extended period of time, I know as time goes by, even though my profit and loss is coming up, my range is going down. So I'm very aware of that. And with some of the more advanced programs, we talk about that and how to deal with that.
Okay. John, I'm getting a lot of calls for you to continue your presentation. I looked at a lot of the questions. I think you're going to end up answering a lot of them. So why don't you just continue?
Okay. Yeah. All right. That sounds good.